All right, let's move into our last segment if we can here, Greg, and that is going to be another edition of Buy One, Hold One, and Dump One. And it's a fun one here today. I think I'm looking forward to what you got planned for us, because you told me you got three different companies out of the copper industry and mining industry in general. And if you're out there watching the show and you've never seen this segment before, we do this each and every Thursday. Coach Greg, we call him the old money homes for a reason. He's got a mindset around investing and dividends and looking at value. He finds three companies, he presents us to us, and then we get to decide which one we buy, which one we hold, and which one we dump. Greg, you're up.
Yeah, so this one, this came to me, just the response the copper futures have had in the last few days there, just last week even, have just been fantastic. And so this is what inspired this one today. And then when I started going through the numbers, it actually even got more compelling. The three companies that we got this time around, Newmont, FCX, and Southern Copper, they all have their little subtle nuances. There's not, when I did the analysis, I didn't see one that just jumped right out at me. I saw things I liked in each one of them. It turned out to be more interesting than I thought it would. Be, but it was just because of this price response of copper. A little breakout 4 or 5 days ago. Even a nice little pullback right now, looking at a bull flag. Copper just looks fantastic right now. So I thought I'd go into the copper companies, and we had discussions that they're not all strictly copper. Some of them are, some of them aren't, but all of them have copper parts to them, I guess if you will. So let's start with Newmont Mining was the first one that I chose. If we can look at that chart for me, Ty. So technically speaking, we've got Newmont Mining. Yep, that's the one. Thank you, sir. So Newmont Mining, got beat down pretty good, past its earnings. Found some support there, working its way higher, just getting above that. I think that's your 200 there. Kind of doji right now. Looked a little bit nicer when I put this together earlier today, but I just like the response gap up today. Like I said, with the copper response in the futures, this has been getting a little bit of love. We'll say that it has some resistance above it. So is it going to take a straight shot back to the 50 MA? Probably not, but I do like the price response of this off this support level down here. So it's not a stock that's the fit for the faint of heart either. On the daily chart, you've got some gapping in there. Like this wasn't even an earnings and it gapped. So you got a bit of gapping. So that's something to pay attention to as well with this one here. You got a fair bit of gapping, but hopefully that gapping continues in the right direction for us here. So Newmont's the first one. I'll run down those numbers, then we'll look at the other two. So we're looking at a $63 stock or thereabouts. Dividend yield is 3.31. Pretty nice yield on that stock there. The consecutive dividend increases is 0. And what you're going to see is a bit of a theme today. These mining stocks don't tend to have the stable dividend pays that some of the other stuff that we brought onto this segment. These they pay according to, or they move their dividend according to usually how they do, and so you'll see that it's kind of all over the place, but nonetheless, decent dividend yield right now. So they started paying dividends in 1934. Payout ratio is real nice at 49%. The PE ratio, which I thought was interesting for Newmont, is 17. So pretty low PE ratio in comparison to some other areas of the market. Assets versus liabilities, they got 41 billion in assets, only 17 in liabilities. Very healthy from that perspective there. They're sitting on about 3.6 billion in free cash flow, which is also a number that I look at quite extensively. Consecutive years of increasing net income. Newmont came in with 4 years of increasing consecutive increases, which is showing some strength as well. I added a little bit to the analysis this week as well. I looked at the options chain and added a little bit here. So Newmont Mining has weekly options. That speaks to its liquidity. When it has liquid options, it tends to be a little bit more liquid. Or when it has weekly options, it tends to be a little bit more liquid, which is good. And then what I did was I took the ROI percentage of a covered call at the money for approximately 30 days. So in this case, it was 29 days for this company, and they came in at about 2.4% for 30 days, approximately 30 days on an ROI of a covered call. So just something to think about from the options perspective, because this is about investing, but it's also about growth, and it's also about cash flow. And so all of these things you need to take into consideration when you're looking at these charts. So that's how Newmont stacks up. The next one I pulled out was FCX, which we talked extensively about. Price response in FCX has been absolutely fantastic. We talked about the reversal here, talked about the high base, talked about the breakout above the 50, above the 20, above the 200, just in a real good space here. This one looks really, really strong. So, and I know, Tyler, you did a fair bit of analysis on that, but just a much different looking chart than your Newmont Mining. But really looks like a decent setup. Past earnings, which is a good deal too. So numbers wise, these guys come in a little bit different. This is where you'll see the subtle differences I was talking about. So FCX around $38. Dividend yield only 0.82%. Okay, 0 years of consecutive dividend increases. Dividends, they started in 1994. The interesting part that I thought of this was the payout ratio. Payout ratio is 12%. It's 12%. So almost nothing, and it kind of is reflected in their small dividend there as well. Now, very interestingly enough, with the chart the way it looks, they're sitting at a PE ratio of 30, so quite a bit higher than Newmont Mining. Not exactly the same company, but similar in nature. Assets versus liabilities, you got 42 billion versus 23, so still good. Free cash flow, they're sitting on 4.4 billion. Very, very healthy free cash flow there. Got 2 years of consecutive net income increases. They have weekly options. And then the ROI for the covered call here was absolutely fantastic at a 3.9%. Now that's the at the money. Most people I know are selling out of the money, but good to note that even at the money there, that's pretty healthy. Sales growth, I forgot, sorry, on Newmont was 15% versus 1.8. And sales growth for FCX, 61% this year and expected 8.8% next year. So that's how the numbers of FCX works out. So a little different stock in the same space, but a little different than Newmont Mining. And then thirdly, we have our friends at Southern Copper, SCCO. So this one here, double bottom here, kind of W pattern, broke up above all the moving averages there today, got above that 200, above that 50, pretty significant run there. Got lots of free air there as far as I'm concerned. Get back up to that 83 high there. So like this chart too, it looks very similar to FCX, and it had a run up. It had kind of a beat down, found some legs, and now is starting its next leg higher. So chart wise, I like this one a lot as well. Got a dividend payment coming up soon as well. So the most expensive stock of the bunch was this one, $67 in that neighborhood, but their dividend yield was 4.14%. So pretty fantastic on the dividend yield there. Again, 0 years of consecutive dividend increases. When you look at their dividend data, it's up and down as they do business. So dividends started in 1996. Now their payout ratio is 80%. So not exactly redlined, but you're much bigger than the other two that we looked at. Their PE ratio comes right in the middle of a 24 as opposed to the 30 and the 17. Assets versus liabilities, 17 versus 9.6. Free cash flow sitting on 2.36 billion, healthy enough for a company. 2 years of consecutive net income increases. They do not have weekly options. They have monthly options. Their ROI for a covered call for approximately 30 days at the money was 1.4%. There is an asterisk beside that. If you looked at the money, the at the money happened to be about $2 away from what the current price was on that. You guys would see that when you looked at the option chain. So that one gets a little asterisk beside it. If I could have got closer to the strike price, that would have been a little bit higher as well. But still, even 1.4%, and having some available capital gains is decent as well. Sales numbers, 31.9% this year and -5% sales growth next year. So that again paints a different picture. So 3 companies in the same space, but very different metrics for all 3 of them. So this comes down to which one you're going to buy, which one you're going to hold, and which one you're going to dump.
This is an interesting one, and obviously, thank you for laying out the game here for us, Greg. And you got 3 different companies, obviously within mining. We got Newmont Mining, which is traditionally a gold company, gold miner, with only just a little bit of copper component. Freeport McMoran, which is mostly a copper company, and then Southern Copper, which is also mostly a copper company. All areas very attractive in the market right now. Copper has been developing a nice little trend recently. We saw what gold was doing recently. It's going to be a tough one, I think, for the coaches. Tyler, if you can do a quick synopsis of the data, then we'll see. I don't know who wants to go first. I'm thinking Matt on this one. Yeah. Tyler, give us a quick synopsis of the data, just a roundup so that everybody out there kind of knows what the question is. And by the way, if you're in the chat, play along with us. Which one would you buy? Which one would you hold? And which one would you dump? But Ty, go ahead.
All right, so I'll just quickly point out the key variable in each column. FCX is the cheapest. That stands out to me. Highest dividend yield is the SCCO. Dividend starts, Newmont Mining's been paying longer than the other 2. SCCO, to go along with the higher dividend yield, it's because it's paying out most of its earnings. FCX pays out barely any. PE ratio looks like Newmont Mining is the cheapest from a valuation perspective. FCX is the most expensive. Sales growth this year was highest for FCX, probably why its stock price has gone bananas, and has the best growth next year as well. Assets, liabilities look pretty consistent across the board. Newmont might be the best from a percentage perspective. They all have plenty of free cash flow. FCX has the most free cash flow. Question, Greg, are the dividends taken out of the free cash flow? Like, is this after paying dividends or before?
Yeah, that's just money sitting there. It's in there on the balance sheet.
Cash on hand.
It's unencumbered.
Got
so
it.
It's not where the dividends come from.
Understood. Okay.
Sorry, let me qualify that. If their dividend payout ratio was over 100, then yes, free cash flow would be probably taken.
It's the money they have in Iceland, Tyler. Nobody can touch it.
Yeah. I got it. Okay. So does it make sense that because FCX has the lowest payout ratio, they have the most free cash flow, or you don't necessarily compare those 2?
No, the payout ratio comes from their earnings, right? So it's how much of their earnings they're paying out. So that I don't think there's a correlation between the free cash flow and the payout ratio.
Okay. Net income increasing number of years, 2, 2, and 4. Not much to write home about there. FCX and Newmont Mining have the weekly options, and then their ROI, FCX highest, followed by Newmont, with the understanding that SCCO, you didn't really have an apples-to-apples comparison.
Yep. Correct. Maddie, you're up. Which one would you buy? Which one would you hold? Which one would you dump?
Oh, this is in my wheelhouse. I can't tell you how many hours I have sitting in my chair analyzing the fundamental data of these 3 companies for many different reasons, but specifically every single year, these 3 companies are debated extensively for Tackle 25. Newmont Mining is a gold company with a copper kicker. Newmont Mining is the obvious hold, in my opinion, because of it. Fundamentally, I don't have a discernible difference opinion on the 3 companies, quite frankly. But when you're looking at FCX versus SCCO, to me, what it always comes down to, and why FCX is always on a Tackle 25 list and SCCO wasn't up until, is the weekly options and the amount of money you can create from a cash flow perspective in FCX is not debatable in comparison to SCCO. FCX fundamentally versus SCCO are very similar in my opinion. You're talking about one company, and the fundamental data is going to change based on where you're getting that fundamental data and how often they update that based on their type of data stream. But I got FCX and SCCO fairly similar from a valuation perspective. Forward P ratio is probably a little bit better on FCX. PEG ratios are both going to be fairly concerning, but SCCO is a little bit better there. Price to book, both are going to be fairly consistent. Recent earnings reports, FCX came in at 77 cents versus the 73 cent expectation. SCCO came in at 121 versus 115. They're very similar companies, quite frankly. What it comes down to me for is FCX is always going to be the better cash flow candidate because of the liquidity in the options market, because of the types of options you have, and because of the volatility of FCX versus SCCO. FCX is one of the most popular trading vehicles from a cash flow perspective in the entire marketplace. Because of that, I can never choose. I have never been able to choose SCCO as much as over FCX outside of certain moments in time. But FCX is the one for me. But it's close. I really like SCCO from a company perspective. It's the weekly options and the liquidity in the options market that is just so important for cash flow systems. And FCX is a darling in that environment.
Tyler, you're up next, man.
I should have gone first because I have nothing new to add. Those were my three, no joke. So I would have held NEM, I would have bought FCX, and I would have sold SCCO because FCX is a better trading vehicle. I'm trying to think if there's anything I would add to that. I think the only thing I would add, like why buy FCX over Newmont Mining? I just think I like the volatility of FCX better than Newmont. I think I have stronger feelings about FCX than I do Newmont. And so I feel like
momentum behind it too.
Charts.
Yeah. And I feel like there's more you can do with it because you got the more juice in the options. And so because I feel stronger about it than Newmont, it takes the cake for the buy.
And mind you, out of all of them, technically, I like SCCO the most right now. From a technical trigger reversal break up above the 200-day moving average, SCCO looks good technically, in my opinion. Even it hasn't been performing as well as the other two, but I do like the cleanliness of this reversal that SCCO has had, and getting right back above all those moving averages post earnings, held the earnings movement back to the top side. I think there's a lot to like technically here, but because technically is the only thing that I feel stands out against the other two counterparts, you got to pick one to sell, and against FCX, SCCO typically loses.
Yeah. Market three, Tyler. I got nothing that I want to change there. I was with Matt on the technicals on SCCO. I mean, that's where my only debate was here for the game purpose itself. I actually own two of the three of those companies. I own Newmont Mining and Freeport Mac. I don't own Southern Copper. So I've already kind of said what I wanted to do with these. And they're wonderful cover call stocks, and they are on two of the different lists on the Tackle 25. I believe Newmont Mining is a dividend fireworks stock, and FCX is a dirty, sexy money stock, if I remember correctly, Matt. So wonderful companies. Is nothing really against SCCO. You're going up against two really, really strong juggernauts in the space. So, Greg, we've got
Newmont's debated as one of the best stocks from a cover call perspective in the entire sector.
In the market. Yeah.
Like out there. Same thing with FCX. So it's not a slide against SCCO. There's a lot to like about SCCO, but again, you're going up against two darlings, I would say, from a cash flow perspective.
Greg, what you got then? What do you agree with our analysis on? What do you disagree? What should we have learned from the segment?
As much as I hate to do this, because you guys know I'm a massive contrarian, I've actually got to go the same route, hold, buy, sell in the same order, but for a little bit different reasons. I want to make one note about SCCO, even though they have monthly options and not weekly, which I would love to see the weekly options in there, because again, that would change that ROI perspective, and I think it would put you, much closer to the FCX numbers. But this comes down to potential growth versus investing stability, if you will. For me, I love Newmont because it's been paying dividends since 1934. It's got a 3.31% yield. It's got a low PE ratio, so I'm getting some value there. It's got lots of free cash flow, so I don't worry about too many problems economically speaking. Their net income's doing well. But if you look at their 3.3 and you look at their 2.4% that you can get on a covered call, that's a fantastic the fantastic way to cash flow a pretty good stock, in my opinion. So that would be the hold for me. What it comes down to between SSCO and FCX, even though I think they should be paying a much higher dividend, I understand that. What I like about it, actually, and I don't always look at this, but I'm looking at it in this particular story, is if you look at the sales growth, 61% this year, 8.8% expected next year for FCO. Obviously, lots of free cash flow. Everything else holds up. Big covered call ROIs, which we like. But then you look at the SSCO, decent numbers this year, but they're expecting a downturn next year from a sales growth perspective. And that's really, as Matt kind of pointed it out, it was almost flip a coin between those two. I really like the technical setup of both of them. I think there's ways to play both of them that can be very lucrative. But at the end of the day, I got to go with what's going to give me the best opportunity, and that sales growth makes me. And again, I don't put too much emphasis on sales growth because those are projections. But you got to say that if one's projecting negative and one's projecting positive, then there's definitely a divide there. So I would sell SSCO. I would buy FCX because again, what you're lacking in dividends, you can make up in cash flow pretty easily. Plus, you can also make up in some growth. Now, I'm not crazy about the 30 PE, but as Matt said, the forward PE looks a little bit better, so that's fine as well. So yeah, same breakdown. Just like I said, I wanted to add that SSCO, their monthly options are very liquid. So that's not a problem if you decided that was your way to go. They are very liquid from a monthly perspective. It's just that they don't have the weeklies, which I think is doing it a bit of an injustice because their strike prices actually are quite wide as well. And
Greg,
that's the issue.
If SCCO had weeklies, it would be a much closer argument.
100%. That's exactly
they're
my
both
point.
good companies.
Yeah, 100%. And technically, as you said, I really like the technical setup on both of them. I think they both look fantastic.